Hello to him, Jonathan. Thank you for joining us. It's been good for India. Last 45 days, looking at
Yes.
benchmark indices, you cannot find a fault line. But is this as good as it gets, or?
Well, for the Sensex, we think 45,000 is a reasonable one-year forward target, and that gives much more upside than we have for global emerging markets, so double-digit upside, more or less, and whereas we have only 2 or 3% upside for global emerging markets. I think there's a number of things that India has going for it. Obviously, there's the government coming in for a second term. We've got an interest rate cutting cycle underway. We've got the oil price falling, which is always helpful. I do think the banking sector issues attract a lot of attention, but I think we are getting closer to resolution on those, hopefully. And as that happens, we should hopefully start to see growth picking up, which is very, very important to sort of deliver on the opportunity here.
You know, before I move forward, I just want to go back and talk about the abundant record flows what Indian markets got, especially in the month of late March, early April, and mid-May. What explains that kind of an inflow into Indian equities? Was that largely global positioning or something India specific?
I think it was a confluence of factors. It's not the only market that benefited from a resumption of flows in that period. Brazil, which were also overweight, did. I think what you're seeing is that investors are putting a question mark over the performance of some North Asian markets that are very trade sensitive, and where also their stock markets are quite geared to two sectors that are in deep trouble globally, the auto sector and tech hardware, sort of semiconductor memory stocks, etc. Mobile phone handset related. So when you look at India, it's actually got this domestic driver, but it's also benefited from the outflows that we've seen from other markets in the region.
When we started the year, the general view was that India was almost neutral to mild overweight for global portfolio allocators. Is that the position still now?
Yes, if you go back to maybe 18 months, 12, 18 months into the first term of the Modi government, that was when foreign investor weightings in India peaked at almost double benchmark at one point. So benchmark being 6 or 7%, we had clients who were mid-teens exposure to India. That came all the way down and was only a very modest, as you say, neutral to mild overweight by the turn of this year. And now people are starting to re-engage.
Now, from a global investor standpoint, MSCI is always the important benchmark. Even though China A shares market share percentage is going higher, given that Chinese stocks have not rewarded investors a lot, at least the last 4 or 5 issues which have gone public, looking at there is a perceived fear in China in terms of a slowdown. Do you think even though MSCI waiting for China shares could be different, markets like India would actually benefit?
So China A shares were the best performing market in the world by far in the first quarter, but then as we went into the second quarter, it became more obvious that the policy stimulus wasn't really helping the economy recover for various reasons, and then the trade and tariff issues resurfaced in early May, so that's part of that rotation we were just talking about. So the index inclusion is ongoing. In late May, actually the first of the inclusion factor increases took place, but it means that A shares will gain in the benchmark to become around 3% by the end of this year. But that's certainly something that active investors, they don't have to track the benchmark with that degree of move. So what we're actually seeing is that whilst foreigners were buying A shares very significantly November through to end of March, at the moment they're selling significantly through the Connect program, and they're reallocating to India and Brazil and Indonesia, and actually at the margins also to Japan. So there's this interesting reallocation going on.
And do you think the allocation which have come back to India early this year, mid this year, that will remain firm and that could accelerate as we move into the second half of this year?
Depends on the overall constellation. So it requires further interest rate cuts, long-dated bond yields to continue to be stable, if not down. The oil price to remain well behaved, and the new finance ministry team, which is coming in, needs to start delivering, particularly on the public sector bank recap, dealing with the issues in the shadow banking sector, which have been quite significant. And those two issues, I think, are part of the reason why growth has been subdued. So we need that growth rate to pick up.
Frankly, if I do a scorecard of NDA1, which is the previous 5 years of the NDA1 government, well, the mandate was strong. Policy changes were quite robust, but the net impact on the earnings so far has really disappointed all of us. do you think investors are going to take this current mandate with a pinch of salt, or they are convinced that some of the powerful reforms may see benefit both in terms of economic growth and also in terms of earnings growth in the second tenure?
I think there were some considerable achievements in terms of bankruptcy law, in terms of the GST. I've covered India for over 20 years. We've waited a long time for GST. In terms of the digital India, the actual digitalization of government services. And actually foreign direct investment really moved significantly higher, and infrastructure delivery improved significantly on multiple fronts. So there's actually quite a lot that was achieved, and it has been significant budget discipline. But the overall growth environment, I think, has been somewhat disappointing, and now I think it's really time that the banking sector issue is dealt with, because aggregate demand is never going to be the problem in India at this stage of development. It's really a question of financing that in an appropriate manner with an appropriate suite of financial institutions, and that's a problem that many emerging countries wrestle with. But I think it needs much more focus at the start of this administration, this second administration.
The only engine which I guess has worked for India for last couple of years has been the consumption engine. And the high frequency data now seems to be telling us that we could be in for maybe not a deep rooted slowdown, but a slowdown is something which is real. It is on our face now. Autos, airlines, movie tickets, two-wheeler sales. How does one really use the current scenario to understand India and invest better in Indian stocks?
Well, this slowdown that you're talking about is manifested on a worldwide basis, so we are very cautious about the global growth outlook. We're actually more concerned about countries in North Asia that are very exposed to the trade and tariff dispute between the US and China, and have these complex supply chains with a lot of interconnectedness in manufacturing with US and China. So that does include Korea and Taiwan. We're less concerned about India in that regard. But we do think there are important issues that need to be addressed here to get growth going again, and particularly in terms of the key sectors in development like real estate and private corporate capex. Those have been weak, and they need to be addressed.
So the script of how Indian markets have moved in last couple of years has been a function of largely PE re-rating and a lot of liquidity. What do you think would influence the script of next 3 to 5 years now?
Well, from a demographic perspective, India, along with Indonesia, is extremely interesting because you're in that stage of household formation and savings, which speaks to the stock markets tending to do well. So when people are in their 30s or 40s. And if you look at the domestic bid for equities and the growth of domestic mutual funds, that's been a key feature here because, as I said earlier in this interview, foreign investors reached their peak enthusiasm about India really 18 months into the first administration. I think they can turn around at the margin as they are, but it's very important that the domestic mutual fund investor bid remains in place.
We're having a long chat with Rhythm Desai yesterday, and his view was that try and identify pockets of where earnings surprise could be, because that's the time when stock prices they give you a lot of upside. Where do you think markets currently are underestimating the growth, and in your work, in your understanding, we are in for an earnings surprise?
Well, we work very closely with Rhythm clearly, so the overweights that we have in India do include industrials, consumer discretionary and private sector financials, whereas we're more cautious on some of the exporters, particularly because we think the rupee will be reasonably strong. And again, one of the interesting features of the last few weeks is the rupee, along with the Brazilian real or the Indonesian rupiah, has been very strong versus North Asian currencies like the renminbi or the Taiwan dollar or Korean won, and that's quite unusual. So we have a bias for domestic demand plays, and we're basically arguing that this domestic orientation of the Indian market is an attractive feature right now. But in terms of the earnings growth and the multiple, our Sensex target 45,000 seems like 18.5 multiple, something like high teens to 20% earnings growth, that earnings will bounce back and that growth will bounce back. If that doesn't come through, then there would be risk to that kind of target and strategy.
Slightly tactical question, and I guess if I look at the regime of last 5-7 years, especially after post-2008, money was cheap, interest rates were low. That lead to a big re-rating or PE re-rating for global financial assets, and especially markets like India, they saw massive PE re-rating. Global central banks are likely to follow loose monetary policy. That is what it appears right now. So what happens to PE multiples? Because the cost of capital will automatically come down. Fed could cut rates, Indian central bankers are cutting rates, Chinese central bankers have said that we also would be coming out with a stimuli program.
Yes, I'm not a huge fan of the Fed model that would relate the PE multiple to nominal yields. There is a better relationship with real yields and the PE multiple, PE being a real variable. So if you look at actually the Fed and what they were doing in 2018, one of the reasons that the PE multiple fell so much in the US in that year was that real interest rates were starting to pick up. The Fed wasn't just raising nominal rates, it was also shrinking the balance sheet. Now you're right, the Fed is starting to change, and so are other central banks at the margin, including in China, shifting more easy. You have to figure out, though, what actually happens to real interest rates in that environment. If inflation falls off very quickly, it's possible that real interest rates could actually even go up. At the moment, we think in emerging markets, the multiple is reasonably close to fair value. But the problem is that the growth environment is weak, and so for broad emerging markets we only get this 2 or 3% upside, particularly because of weakness in sectors like autos, tech, hardware, and the trade and tariff related sectors.
If potentially we are looking at a slowdown and a tough environment, and if not dark but cloudy days ahead, what strategy is the best strategy? Buy defensives, which is a combination of high dividend yield stocks and consumer staples and autos, or one should continue to buy risk when it comes to India?
Well, we think India itself is a defensive market, and it's proven that fairly spectacularly in the last 4 to 6 weeks. In fact, there have been periods when India was actually going up, Indian equities, on days when the S&P was going down, which is very unusual. So it is anything but a high beta situation. And it shares that characteristic with some other markets, that defensive characteristic. So at a global level, we're not bullish on markets. Our S&P target is 2750, which is clearly below where the index is trading now. But we think India can grind out outperformance in this environment, and it has this somewhat different characteristic that whereas global growth is softening significantly, India and indeed Brazil, which we're pairing together as our two favourite markets, they both have been in a quite depressed economic growth environment for some considerable time now. And there's all to play for in both countries in terms of solving the issues that lead to growth re-acceleration.
Why India and Brazil together? One is a commodity producer, other is a commodity consumer, and I mean, history tells us that they are inversely correlated, not directly correlated.
Well, they both are non-manufacturing in terms of the structure of their economy and in terms of structure of their stock markets. They both are slightly outside of, if not beneficiaries from, the US-China trade tensions. So if we look at India, for example, in terms of manufacturing supply chain relocation into India, that's a theme that is definitely appearing. We've been discussing that at this conference. Brazil is an agricultural superpower. So also within all of this, we're going to see, or we are seeing, reduced Chinese purchases of US and indeed Canadian agricultural product. That's very bullish for Brazil. There's also an ongoing problem on a worldwide basis with swine fever, including throughout Southeast Asia and China. And Brazil is a big protein swing producer in terms of chicken production. So these two countries, they both have governments that hopefully will be energized around reform, and they both have had quite depressed economic environments, but there is a possibility for growth to actually surprise on the upside in these countries at a time when we think it's going to surprise on the downside, including in the US, elsewhere.
Since we are repeatedly revisiting the whole issue of trade war, what you've always expressed over the years is that don't focus on the news, but try and figure out how much of the news is in the price. How does one know that the current trade war, whether it's a good template or a bad template, is something what markets are already pricing in? Because what we are discussing today, I'm sure markets would have reacted to that yesterday.
Well, we cut our target for broad emerging markets twice in May, once at the start and once at the end, as this issue resurfaced, but also as growth data came in somewhat weaker. So we're constantly thinking about this and trying to evaluate the situation. At the start of the year, when it looked like the trade and tariff situation was de-escalating, and at the same time as the Fed pivoted in January, which was a surprise, to an easy stance, and China surprised on the upside with its credit policy, that was good for the multiple and good for EM. So it's a very turbulent environment, and it's something that we just have to give our best efforts to on a daily basis.
Now, you've been tracking India for 20 years now, and it's always a pleasure, and I look forward to our Morgan Stanley interactions. But what is one thing which has constantly surprised you about Indian markets, and what is one thing which has constantly disappointed you?
Well, I think it's always worth taking a step back, and if you look at all the countries in the emerging index over the period that I've covered them, there are two that have structurally outperformed over the cycle. One is China, and one is India. So in fact, the correct strategy, if you'd had perfect foresight, is to have been overweight those two markets and to have stuck with them. In the case of India, I think it's interesting that I would say, in terms of disappointment, I would say the overall growth rate in India has not achieved its potential. But corporate performance has been very strong, and the execution of certain business models, both in the domestic and exporting side, has been very strong. So it's interesting that you would probably characterize the micro execution as stronger than macro execution. But then I must say, well, we went through the detail. The first Modi administration changed a lot of things, did a lot of structural reforms that should bear fruit longer term. The one element that wasn't dealt with aggressively enough is the banking sector and shadow banking issues.
Jonathan, again, I'm just talking a little bit about how you started tracking India 20 years ago. 20 years ago, if you bought into private banks, voila, you've hit a home run, whether it's HDFC or ICICI, or for that matter, even IndusInd Bank. 10 years ago, if you bought into NBFCs, you've hit a home run. You've got Bajaj Finance, and you've got several other NBFCs which got created. Indian markets give you these periodic trends which are structural in nature. Is there any large mega trend which you're betting on? It could be a 3-year trend, 5-year trend, a 15-year trend, which you think will really capture the advantage of India's demographics and India's young population?
Don't forget also, in terms of historical performance, we've had very strong performance from part of the contract outsourcing software sector, and though the pharma sector, the generic pharma producers, have done less well recently, there is a period when they had done exceptionally well too. So it isn't just the domestic plays that one's been able to tap into. And I think going forward, the really interesting thing will be to see whether manufacturing in India, the Make in India campaign, can actually gain fruit in this turbulent environment where supply chain relocation is going to happen, and as the domestic market develops here. So when we do some of the survey work with multinationals about supply chain relocation in quite a wide range of sectors, so including things like auto components, handset assembly, parts of the chemical supply chain, etc., India does get mention along with Vietnam and Indonesia as a credible destination. So that will be very interesting to see.
I've got two follow-up questions. If you're looking at years and perhaps decades, the demographic advantage, the young population of India, the fact that a lot of our financial services are underpenetrated will keep this economy going. It could be a dip for 1 year, it could be a dip for 2 quarters. For someone who has a 5 to 10 year view and said, look, I can digest a 10% volatility, I can digest a 20% downside, but I want to buy India, what is the best way to participate?
I'm somewhat skeptical about using these demographic arguments to invest in an equity market. In fact, there's relatively little relationship between population growth and equity market performance, or even between GDP growth and equity market performance. What matters is, are there the business models that generate sustainable ROE that allow the equity market to do well. So, for example, right now in Japan, which has quite adverse demographics, our thesis on Japan, which is broadly panning out, is that corporate ROE is structurally improving for a variety of micro reasons, micro execution reasons. So I think it comes back to my answer to your previous question. It's all about the business models and the companies. We have a fairly good idea about which ones work right now, but it would be good to see more IPOs here, and particularly in, let's say, the internet, software, say the travel-related areas, both internal and attracting inbound tourism traffic, that kind of thing. The sort of sectors that you see IPOs occurring in China, Hong Kong, and the US, that India's somewhat underrepresented in that sense.
So, closing comments, and again, I'm just going to take a leap from the sectors you mentioned, whether that's travel, hospitality, or perhaps in the food category. Every tree has a seasonal fruit, and every cycle will throw out fresh gainers and fresh losers. If we are on beginning of a new cycle, where do you think disproportionate gainers or winners will emerge in this cycle, at least in India?
Well, I think it does come from, as it does worldwide, from this very interesting changing consumer behavior. So a tendency of consumers to be less interested in buying physical goods, particularly things like cars, and much more interested in experiences and lifestyle and topics like health, for example. India has a lot that it's offered the world in yoga, for example, and that's something that I myself do in Hong Kong, and it's been great for my life. So there's certain ways that I think India could tap into some of this changing consumer behavior on a worldwide basis, using its history and its capabilities, that could be quite exciting in terms of business models, and we're starting to see that.
At a time when there is a lot of gloom and doom at global level, it's good to get a sunny voice, and always look forward to interaction. So thank you very much, and thank you for being an India bull.
Yeah, not at all.